Bitcoin's ledger just flashed a number that will define the next decade. Long-term whale wallets, those addresses holding more than 1,000 BTC, have net added 800,000 Bitcoin in the past 30 days, a new all-time record in on-chain history. Pause on that. 800,000 coins valued today at nearly $40 billion moving into the hands of those who've shown the greatest conviction. And yet, the price sits only modestly higher, defying everything we thought we knew about supply-demand dynamics. This isn't a glitch in the system. It is the system, revealing its next phase. We step into this story mid-tension. An unseen tide is rising beneath the surface of charts and headlines. Macro funds, sovereign wealth, family offices, they're not chasing a short squeeze, they're executing a migration. This is no longer speculation. This is sovereign accumulation at scale. As Joseph Schumpeter taught, capitalism evolves through waves of creative destruction. Bitcoin's first wave was speculative mania. The second was institutional entry via spot ETFs. Now we're entering the third wave, structural wealth transfer, where the largest holders abscond to stronger ground. Consider why the price isn't exploding. It's because this isn't a trade. It's an installation. Institutions aren't paying premiums. They're acquiring collateral. In Peter Drucker's systems thinking, what matters is the network effect. When the heaviest nodes whales amass twice as much as miners produce in a month, you're not watching supply scarcity. You're watching network entrenchment. This $40 billion flow into long-term wallets won't show up as a spike. It will show up as unshakable support. Daron Acemoglu reminds us, institutions shape technology's trajectory. When pension funds and endowments allocate Bitcoin to their books, they're not chasing yield, they're rewriting governance. This is no longer rogue code. It is becoming global monetary infrastructure, quietly fortified by entities that define policy and capital flows. So what just happened? Last month, on-chain analysts across platforms like Glassnode and Sentiment flagged whale addresses bulking up at unprecedented rates. At the same time, funding rates fell to multi-month lows. In normal markets that conflict. But here it signals a quiet accumulation phase. Leverage neutral, skewed long, no mania. As Nassim Taleb's anti-fragility principle suggests, Bitcoin is thriving amid stressed geopolitical tensions, inflationary pressures, banking system cracks reinforcing its role as a hedge, not a hedge fund play. Amy Webb says, futures are built by those who imagine them. These whales are not imagining short-term gains. They're programming a future where Bitcoin sits at the nexus of finance and technology. They're hedging against currency devaluation, against sovereign debt crises, against the erosion of institutional trust. This is the most audacious experiment in monetary innovation ever undertaken, and it's being underwritten by the richest balance sheets on Earth. Look deeper. The miner sell pressure is down 45% year over year. Why? Because miners see this tide and choose to hold, anticipating far higher long-run values. They are whales, two algorithmic supply managers who understand that a structural reallocation is underway. Miners supplying raw issuance are now dwarfed by whales demanding supply. It's like watching a funnel where demand outpaces production, day after day. In a classic Keynesian sense, liquidity preference has shifted. Holders prefer the liquid solidity of Bitcoin to the liquidity of cash itself. Yet retail barely notices. The crypto fear and greed index hovers near neutral. Social volumes dwindle, and Google Trends for Bitcoin show no mania. But that's exactly when revolutions are born, when the public narrative is complacent. Daniel Kahneman warned against, what you see is all there is. Retail sees a sideways chart. Whales see a tectonic shift in capital allocations. They see capital flows that dwarf everything from gold ETFs to bond fund inflows in months gone by. Thomas Piketty's analysis of capital concentration finds a parallel here. Wealth begets wealth. But in Bitcoin's case, concentration does not imply centralization of power. Instead, it cements decentralized resilience. Because these whales are custodial or institutional entities bound by regulation and governance, not solitary actors. They form a lattice of accountability that underwrites Bitcoin's legitimacy. This is paradoxical. The more you concentrate Bitcoin in regulated hands, the more decentralized the system's trust becomes, because trust no longer resides in individuals, but in contractual frameworks. Ask Yuval Noah Harari. History moves in leaps, not lines. We're at a leap point where money, technology, and politics converge. Whales bulking up is not just a financial event, it is a megatrend inflection. As cryptocurrencies integrate with central bank digital currency pilots, DeFi primitives, and global payment rails, Bitcoin stands alone as the original Layer 1. Its scarcity, predictability, and neutrality give it gravitational pull. This recent whale accumulation is the gravitational center drawing in every orbit of innovation. But why 800,000 coins now? The answer lies in timing and narrative alignment. Macro uncertainty peaked this quarter. U.S. budget impasses threatened debt defaults. Currencies tumbled, European energy crises loomed. In that context, Bitcoin was the only asset with a predetermined, immutable monetary policy. Long-term whales sensed the synchronicity of events. They weren't chasing headlines. They were anticipating regimes collapsing. Mariana Mazzucato describes mission-oriented investments. Capital flows aligned to a grand challenge. Here, the grand challenge is preserving global wealth against monetary dilution. Whales are mission investors. They're underwriting monetary sovereignty. This is not greedy accumulation. It's protective accumulation. They're building fortresses around Bitcoin's scarcity, stone by stone, whale by whale. Let's return to supply mechanics. The April halving slashed miner issuance to 450 BTC day. For perspective, 800,000 BTC is what miners used to produce in 4.5 years. Whales have gobbled that in 30 days. It's as if the river feeding a reservoir suddenly reversed, pouring into what was once its source. That flow can only continue if incremental demand absorbs new issuance and existing supply dries up. The ballet of accumulation intensifies until we hit a supply cliff, a moment when orders overwhelm order books, and institutions know this. BlackRock's daily net inflow streak continues. Fidelity's custody pipeline expands. ARK Invest quietly increases its spot exposure. Family offices from Hong Kong to London are allocating 1 to 2% of their portfolios, hedging against conventional portfolios' underperformance. None of them expect a moonshot this quarter. They expect a multi-year remodeling of portfolio architecture. That's why they're content to buy into a modest price environment, a false calm before the storm of adoption. Ian Bremmer's concept of geopolitical risk underscores why Bitcoin's decentralization is vital. As great power competition intensifies US versus China, NATO versus Russia, the financial battleground extends beyond sanctions into capital controls and currency weaponization. Bitcoin is the neutral ground, consensus-based network that no single power can commandeer. Whales perceive that neutrality as an asset unto itself, and they are capaciously stockpiling it. Now factor in monetary policy dynamics. The Fed's latest minutes hint at a pivot rate cuts, possibly on the horizon. Historically, rate cuts fueled risk assets, but will they drive Bitcoin? Perhaps not in a linear fashion. Because Bitcoin's drivers are not just interest rates, they are structural trust shifts. When authorities loosen rates, traditional assets rally, but Bitcoin stands to gain most when trust in policy shifts is weakest. This accumulation phase straddles the pivot window, positioning ahead of the taper pivot, ensuring that when the market transitions from hawkish to dovish, Bitcoin's narrative moves from alternatives to core asset. What about behavioral finance? Conviction is contagious. Human actors see powerful whales moving. They see accumulation charts with parabolic curves. They hear experts pontificating about capitulation or FUD. Yet price remains muted. That cognitive dissonance is a mental barrier for retail. They think, if price isn't soaring, maybe I'm missing something. But the whales don't want price skyrocketing, at least not until they've absorbed enough supply. This is the distribution of demand over time. The whale's strategy is to build silently, then let retail participation come at higher prices, ensuring they retain dominance. Now imagine the catalyzing event that unleashes the next wave. A major bank failure triggers capital flight, or a sovereign debt default shatters confidence in fiat. In that moment, the demand for safe haven assets will surge. But Bitcoin's available float will be minuscule, most supply locked away in long-term addresses. Order books will evaporate, spreads will widen, and the price will gap. That gap will represent not just panic buying, but the crystallization of years of structural accumulation by the largest wallets. As Milton Friedman's monetary theory would indicate, an asset with a stable supply and Predictable issuance schedule becomes money. A hedge when fiat fails. Bitcoin's deflationary design cemented by its code makes every break in supply all the more meaningful. Whales are front-running that revelation. They are buying coins today whose purchasing power will expand as currency units decline tomorrow. Jane Jacobs spoke of the importance of local networks in urban renewal. Bitcoin's renewal is happening in the global on-chain network. Long-term whales are the local stewards of this rebirth. They're planting seeds, reinforcing nodes, and ensuring the network's robustness. Their wallets become Arc Wallets repositories of value that survive economic floods. And when those floods come, those wallets will not only preserve wealth, but define the boundaries of a new global economy. In Don Tapscott's vision of the blockchain revolution, transparency and trust are programmable. Whale wallets, though large, are transparent. Analysts can trace their flows. That traceability lends legitimacy because it shows accumulation without concealment. The world is watching these addresses load up. The narrative shifts from fear of whales manipulating price to trust in whale conviction. It's the inversion of a century-old adage. Big players can now be visible without losing strategic advantage. As we near the 800,000 BTC milestone, realize this: it is not merely a record. It is a turning point. History will mark this as the moment when Bitcoin graduated from emergent technology to institutional asset. The next chapters won't be written by retail frenzy, but by boardroom decisions, sovereign mandates, and regulatory frameworks that bake Bitcoin into the architecture of global finance. So here's your call to action. Don't chase the price. Don't oscillate with every headline. Instead, follow the whales. Monitor on-chain metrics, net growth and long-term wallet balance, minor supply changes, ETF custody numbers, and correlation with macro indicators. Those data points map the underlying narrative. When the next crisis hits, you'll know that this record whale accumulation was not noise. It was the baseline of the next paradigm. Long-term whales have added 800,000 BTC in 30 days. That's not a flash in the pan. That's the quiet revolution that will define Bitcoin's trajectory for the next decade. The chart can correct. Volatility can waver. But the narrative of institutional conviction, once codified on-chain, is irreversible. Listen closely. This is not a story about price. It is a story about power, about who controls the base layer of tomorrow's money. And tonight, those wallets just got stronger than ever.